Once again, we're going back to a situation where this individual has bought a policy, again, last acquired December 1st, 1982 onwards, okay? Once again, he's got $50,000 worth in cash surrender value sitting in his policy. However, this is a participating policy. In our previous situation example, we used non-participating. But in participating, remember, the client, of course, has 5 different options. Okay, doesn't really matter which different option they take. The point is that they receive a dividend, and so therefore it is considered a participating policy. And so now the premium in a participating policy will naturally be a little bit more than a non-participating, because that excess premium, of course, will go to invest in the company's investment options and everything else, and you in turn will receive some kind of a dividend on the anniversary of your policy and everything. And so therefore he's going to pay a little bit more, so $2,500 for 10 years. So once again, just like we did before, we have to do step 1, which is calculate the ACB. That's the very first thing we do. So in this case here, again, total premiums over the 10 years, he paid $25,000 in actual premium. However, remember that because it was last acquired December 1st, 82 onwards, there is the NCPI, and that is $5,000. So notice that the $5,000 is exact same whether it's par or non-par, because insurance is insurance is insurance. It doesn't really matter what product that is. It all depends on your age, male, female, and your smoking status. That's basically what all it comes down to. And of course, the volume of insurance. Because the NCPI doesn't change just simply because you're buying a par or non-par. It stays the same, essentially, okay? So for this particular client, it's still going to be $5,000. So during that period of time, he gave us $25,000. We had to insure him for $5,000, and it cost us $5,000. But also during the same period of time, he received $6,000 in dividends. As I said earlier, it doesn't really matter what you spend that $6,000 on, what you use dividends for. Okay, the point is that you did receive a benefit. You did declare. Okay, we did declare to you $6,000 of actual dividends during that same 10-year period of time. So therefore now, the ACB formula basically is once again proceeds of basically, in other words, premium paid that you paid in, minus your $5,000 of NCPI, minus your $6,000 dividends. So notice the NCPI and the dividends reduce your ACB. So basically, it just simply reduces the amount all the way down. And so now we're down to $14,000. So now on the participating policy, the ACB is slightly different because of the fact that you've got that dividend that you have to deduct as well. So therefore, your new ACB is $14,000. So now we know that part of it. And now, of course, we need to do step 2 in terms of what is the policy gain.